So now that we've figured roughly what's going on, let's throw some numbers at it and work through a fairly simple example in relation to a joint venture. So what we have here are two ventures, A and B, each putting in some assets. A puts in $400,000 worth of cash. B has some equipment. Who knows what it is, but B has some equipment with a carrying value of $600,000. Now, this can happen. I mean, ventures don't necessarily all have to put in the same assets. They can put in different sort of assets, as long as they all agree as to what the value of those assets are going to be in relation to the joint venture. Importantly in this case, the carrying value in venture B's books, the carrying value of that equipment is equal to the fair value. That makes the accounting much, much simpler. It's not always going to be the case where this assumption holds, and in another example we'll have a look at this. But in this particular example, the value of what B puts in is the same as what it's on its books at. They also have the proportions roughly working out in terms of the dollar figures they put in. A has a 40% share and B has a 60% share. So now that we've figured out what they put in, let's have a look at what the venture does itself. So the venture then goes off, or sorry, I should say the joint venture then goes off and buys land for $250,000. The venture incurs costs of $500,000 to produce output. What sort of output? We have no idea, but it produces output. And it still owes $400,000 for these costs. And lastly, of the output that it produces, 70% in that particular year is distributed back to the venturers, while 30% of it still may be work in progress. It may be finished, but for whatever reason, it is still within the joint venture.